I was profitable, and I got scared. It sounds irrational. You made money. Your investment went up. You were right. And yet, you felt fear. Why does being in profit sometimes trigger anxiety instead of confidence? Let's break it down. 1. The psychology of protecting gains. Once a position becomes profitable, something shifts internally. The gain no longer feels like potential. It feels like something you own. Behavioral research by Daniel Kahneman and Amos Tversky showed that people evaluate outcomes relative to a reference point. When your portfolio rises, your new reference point becomes the higher value. Any pullback now feels like a loss, even if you're still up overall. So the fear isn't about losing money. It's about losing unrealized gains. 2. Prospect theory in action. According to prospect theory, people are risk-averse in gains. People are risk-seeking in losses. This explains why investors often sell winners too early, lock it in, hold losers too long. It'll come back. When you're in profit, your brain whispers, take it now before it disappears. This is not logic. It's survival wiring. 3. The house money effect and its reverse. Sometimes profits create overconfidence, but often they create tension. You start thinking, what if this was the top? What if I give it all back? I don't want to look stupid. In strong markets like the S&P 500, investors frequently exit during rallies, not crashes. Why? Because gains create pressure. Success raises the stakes. 4. Identity risk. Being profitable changes your self-image. You go from trying investor to someone who made the right call. Now you're not just protecting money. You're protecting your ego. If the price falls, it doesn't just reduce profit. It threatens your sense of competence. Fear at a profit is often fear of losing status. 5. The fear of regret. Regret anticipation is powerful. Investors imagine the pain of watching gains evaporate, not selling at the top, missing the perfect exit. So they sell early to avoid future regret. Ironically, this often reduces long-term compounding. 6. Why long-term investors experience this less? Long-term disciplined investors typically predefine holding periods. Focus on allocation, not price. Accept volatility as normal. They don't treat short-term profit as a decision trigger. They treat it as noise. 7. The real question. When you were profitable and felt fear, what were you actually afraid of? Losing money? Losing validation? Losing control? Being wrong after being right? Often, the fear isn't financial. It's psychological. The core insight. Being in profit can feel uncomfortable because gains are fragile. The brain prefers certainty. Humans dislike giving back what they've already mentally claimed. But compounding requires tolerating temporary pullbacks. Final thought. I was profitable, and I got scared. That sentence reveals something important. You weren't afraid of losing money. You were afraid of losing a story you were telling yourself. And in investing, mastering that inner narrative is often more valuable than timing the market.